In this video, we're going to take a look at how to trade the match price or the opening price of a stock. There's a tape reading technique of getting a free look at the market, and I'll explain what that is in a minute. What we have here is A2 Milk on the daily chart, and this is going to be our example for the day. Now we've got a nice big drop from $20 all the way down to 13. We can see a nice horizontal here at 13.02 roughly. It's bounced and closed up at $13 roughly, and then opened up the next day again at 13.01. Now this is the 4th of December 2020, and this is what we're going to take a look at. This is the intraday price action starting from here at 9.59. It's going a bit sideways, refusing to go below that $13 level, and then just shooting to the upside. Now let's have a look at the replay. This is Spark Iguana 2 for anyone who hasn't used the platform, and it shows a visual representation of the order book up the top here, and just a regular order book down the bottom. The blue bar is the indicative price during the auction, and the current time is 9:56.07. The earliest this stock can open is 9:59.45, and the latest is 10 AM and 15 seconds. So what we're going to see, and this is running at 5 times speed, is that really this wall kind of just stays there, and we see some shares coming in front of this wall. Now this is the technique. Effectively, to minimize your loss potential and maximize profitability, the idea is to get in front of this $13 wall, provided that there is a surplus. Now what that means is that when this stock opens, if this stock was to open right now, there would be roughly a surplus of about 50,000 shares. So we can see just how many sellers there are, this blue candle, and we can see just how many shares are remaining here, so about 50,000. So this would be a surplus of 50,000 at $13. Now if there was more sellers than there are buyers, then this would be a negative surplus. We could have negative 50,000, negative 40,000, and in that case, the position would be a short, not a long. So for a positive surplus, I would have a ticket open at around 13.03, 13.04. Now, if this opens up at 13, perfect. We match at the $13 price. The idea is that we get technically a free look. And what that means is if this $13 wall starts getting sold into, we can just sell the stock straight away. We bought in at 13, even though we had a 13.04 price, we actually we opened up at 13. So that's the price that we pay. So we can close out at 13, or perhaps a pip or two if we're a little too slow. So we can see what happens in the auction. This is running at 5 times speed, and we've got about 1 minute left till it opens. So the idea is to minimize risk, right? There's a lot of opening volatility. If you've ever traded a stock in the morning, you can see exactly how volatile it can get. Now, A2 Milk didn't have much news and other stocks were running, so this was actually quite a slow mover for the day. And we can see 13.01 at 9:53 and 52 seconds. A big order came in front of this $13 wall. And we no longer technically have a free look, but we have still a very, very cheap look. So we open up at 13.01. That's what we would have got matched at. And the idea is the moment we see this big wall at 13 getting sold into is to bail out as quickly as possible. That would be a 1 pip risk. Now you might get an unfortunate event where the entire 150,000 share wall gets sold into. So really you still got 1, 2, maybe 3 pips depending on how slow you are. But really I have tickets open straight away, so you know, it really is just a click of a button and it executes really quickly, basically instantly. So I never really have problems with, you know, Xing a stock like this. And really it's about waiting, waiting, and waiting. And unfortunately, in this instance for A2 Milk, this was a slow mover. We can see this wall getting taken slowly. And I think it took about 15 minutes for this stock to run. So I'll just play this back at a little bit of a faster speed. And you just watch the order book. And that's effectively the technique. The take profit target is far less important than your entry and risk management. That's the idea behind this, is to bail out as quickly as humanly possible if the stock goes against you, if this wall starts getting taken out. And look, you don't have to wait for the whole thing to get taken out. That's up to you. But the moment it starts getting nibbled, you know, you got 50,000 shares out of this 140, then that's when I'd start looking at getting out. So it's not just about 1 or 2 shares hitting the $13 wall here. It's about big chunks starting to get taken. It's not very often that you see the entire wall get smashed all in one hit, especially when it's 140,000 shares deep. So you should have time to exit. And you can see it's just about riding the momentum, and really it's just a bit of tape reading. Open up your charts, find out where the exit target is, because now, even if we were to close out here at 13.17, that's a 1 pip risk, 17 pip reward. So that's obviously really, really good. You never want anything worse than 1-to-1, and and for a technique like this, you definitely want more than 1-to-1, because you've got to factor in brokerage as well. So that's the idea behind reading the tape. That's what you want to look for, and it does take a bit of practice. You do have to shop around for stocks in the morning to find the right chart setup, the right order book setup, and when there's a stock in play, whether it's something gapping up real big or there's a big news event, you can typically find big order book walls on stocks like that. So happy hunting, guys. I hope you get multi-bags. Cheers.